Let's pivot back now to private credit, and as we know, it's getting more attention as an attractive asset class, especially among Australian investors. But what are the emerging risks? Patrick Prasad-William, Managing Director of Rixon Capital, joins me live in the studio to discuss. Patrick, thank you so much for joining us once again. Let's just start with the risks, in fact. I mean, we were discussing a little bit before with a prior guest, and I suppose everyone, just in terms of understands that there's a liquidity issue there. That's pretty well known. But what are some of the emerging risks in private credit as you would identify them?
Yeah, Kyle said the emerging risks are more around how managers manage their funds, because at the end of the day, credit's what it is. You pick the level of the capital stack you want to be in. You diligence the business. You allocate pricing that you think makes sense. The risk we're seeing is because it's a new sector, it's a bit of a moving feast, so the funds are still evolving their mandates. So what we're seeing, which is quite common, is where funds have a fixed target return, so call it 6, 8, 12%, but they're permitted to invest right across the risk spectrum. So they can do senior ranking debt, they can do mezzanine funding as well. So the challenge then is, if you've got two funds delivering a 10% return, they can actually have very disparate risk profiles. And
so is that when we're starting to talk about fixed target return versus variable risk? I mean, is that the dynamic that you're kind of pointing to there?
That's right. It reflects more the mandate. So if if you tell your investors, my target return's 10%, you should be underwriting debt that reflects a 10% risk.
Right.
Or less. But if you're allowed to do mezzanine debt or senior ranking debt, so you can say your target return's 10, fill your fund full of unsecured lending at 15, shoot the lights out, get yourself a performance fee. But investors in that fund weren't looking for a 15% return. They wanted a 10% risk and a 10% return.
Interesting. Okay, so from what I understand, almost in economic speak, it's almost like a maybe information asymmetry there between the manager and the potential investor. I mean, is there kind of, I guess, a porous regulatory regime when it comes to this these sorts of assets, and that's why we have less of this kind of transparency, perhaps? Or, I mean, what are the factors here that maybe even differentiate these risks from, just obviously a typical equity portfolio or any other publicly listed asset?
I think it reflects two things. One is the youth of the sector.
Right.
So, until 5 years ago, no one had ever written a private credit information memorandum.
Right.
So there's that. On the flip side, because they tend to be wholesale products, ASIC takes the view that as long as it's disclosed on page 45, it's disclosed. So the understanding is you read the information memorandum. But the average investor isn't necessarily that financially savvy. So they look at the first 5 pages and they get a view around, they read the description, they see the returns, they say, look, this looks good, without actually being able to appreciate the risk.
I don't want to deviate too far from the topic there, but I mean, just coming from my background, and again, don't want to dig into the weeds here, but there's sometimes a one-size-fits-all kind of approach there with trying to make sure that kind of consumers are invested and investors are protected in the space, particularly ones who are perhaps less sophisticated. So is that an element that we have to be wary of there, that there has to be some sort of regulatory catch-up, or at least, again, the message simply has to be sort of caveat emptor to anyone who's entering into this space, because the protections that exist for some of your investments may not apply necessarily yet to the private credit space?
That's partly true. So caveat emptor works for me, I think for a lot of managers as well, because at the end of the day, that's the benefit of a wholesale product.
Yeah.
It's not an overly onerous regulatory regime, and the understanding is you read the documents. Mm-hmm. So I think investor education is key there. Investors just need to get their heads around the fact that don't get taken in by an attractive absolute headline return. Read the document. If you don't understand it, ask an advisor, get some help.
Okay. Can you also just talk us through something here, loan books exposed to legacy loans? Again, a concept that might be a little bit foreign to the average punter, certainly to myself. Can you describe how that sort of plays into things?
Yes. So if you take two examples, so you've got a listed company that invests only in debt, and you've got a private credit fund. They've both written a fixed rate loan in 2021, 4 years, to the consumer lending sector. Mm-hmm. Fast forward to today, interest rates are up 4 or 5%. So that debt should be priced at no less than 15%.
Right.
So it's already underpriced, number one. Number two, the consumer environment isn't ideal, it's not particularly the best. So that debt should be priced at 17 to 18% to reflect that risk. The listed fund would take a 5, 10, 15% drop in valuation. The private credit fund, by virtue of being unlisted, has discretion whether or not they write down their net asset value. And by and large, they don't write down the net asset value. So the risk there is, if you're an investor in that private credit fund redeeming your units today, you're actually getting your units back at a premium price. And the investors that stay in the fund actually wearing a double loss.
Let's just move again to, I suppose, investors wishing to get exposure to the asset class, especially through a self-managed super fund. How does that work, and why might that appeal to someone who might be managing their own super?
Yeah, that's a good question. So, the traditional SMSF or large super investor tends to have focused on the blue chip end of the stock market. That's been the historical go-to. The theory being, of course, the capital value is reasonably stable and you've got a pretty good dividend yield. That's changed in the current market. There's a lot of volatility in the equity markets. Dividend yields aren't particularly compelling. And at best, you're getting a dividend on a semi-annual basis. So private credit becomes a very sensible allocation because A, you're getting genuine capital protection because there is a real asset over which you're secured. And B, if you're investing in an income fund, you're actually getting a monthly distribution. So we've had investors comment, it's like getting a wage again.
Right, interesting. Let's just wrap it in a bow very quickly, especially as it relates to that point on SMSFs. Just, again, investors looking to select their funds, what do they need to look out for? What's some good rules of thumb?
The key things to look out for is what the fee structure is. So don't get taken in by just the management fee.
Yep.
Look in the back because they're permitted to take an arranging fee as well. The fund may be able to take some of your interest out of your pocket as a fee for themselves. That's key, and understand what exactly they're permitted to invest in and not. So if you want a fund that does asset-backed senior lending, make sure that's what it says in the information memorandum, because if there is leeway, the fund will have a right to take that leeway.